Yes, so practically all my research is focusing on monetary policy. so that's why I was able to develop much more than for other topics, and that's why I was able to combine many different textbooks, papers, research articles. Also, that's why I will show you many different calculations related to this topic, because in this case it's much easier to see the data than just talk about it. So first of all, there is one key definition. So the independence and the autonomy of the monetary policy. Because sometimes people, or even sometimes textbook, big handbooks are mixing them together or confusing them together. So independence is an institutional thing. So let's separate the monetary policy, which is a nice thing and it's operated by economists, from the fiscal policy, which is operated by politicians who can be either lawyers or other people who somehow get power. So, because if they are mixed together, and they were mixed usually until the 90s, then this can be a recipe for inflation, because in this case, if elections or something is coming up, then Ministry of Finance can force central bank to decrease their interest rates to have some popularity. So at the end of the day, the concept of independence was created. So that's why usually the head of the central bank and the monetary council has longer mandate than the parliament. Also, they are mixing the different expiry dates, maturity of their mandates. So in this case, they cannot have the same expiration date like the government or voting cycles. And also in the treaty about the European Union and also in the treaty about the functioning of the European Union, it's even written there that neither the European Central Bank nor any central banks within the European Union cannot take or ask for any advice from the national governments or any parts of the European Union. So, dear politicians, please vote for the people who will represent the nation in the monetary council, which makes the decision. But once you voted this guy or girl or lady into this council, then you cannot do anything. So you cannot say and you cannot ask on the phone that, oh, please cut the interest rates because the government is not that popular. Or you can do it, just after that you should not be angry if they are saying something rude. So the independence is absolutely an institutional thing. Case of autonomy, this is the degree of freedom. So as a central bank, what can you do on the markets and what cannot you do on the markets? So increasing or decreasing interest rates, but you have to consider the key central banks. Obviously, you have to consider what is happening at the US Fed, what is happening at the European Central Bank, what is happening in the Bank of England, the Japanese Central Bank, Chinese Central Bank. So we have to focus always on the whole package before you are determining your own key policy rate or before you are calibrating or fine-tune your own instruments as a central bank. Especially if you are an open and small economy or an emerging one where some of the capital is coming from abroad, then this will be even more relevant. And not just the key central banks are really important here, but also since trade relationships, cross-border production chains are linked together, so this will be also limiting factors. And of course, liquidity flows. So global issues, any global shock will have an impact on level of autonomy. So in many cases, we are saying that, okay, there is the Under-Fleming dilemma that if we have floating exchange rate and if we have free movement of capital, then we should have high monetary autonomy. Just the problem is that if we are an emerging or small and open economy, then this autonomy will be really limited. So, not much. Okay, central bank balance sheet. I think that you were able to see something like this already, just I wanted to put it here. But if we have to define the environment where the central bank should survive, then we can see that, okay, so inflation will be relevant for them because they should maintain the value of the currency. So the problem is that inflation is a function of the balance between aggregate demand and supply. So obviously you cannot make food or cannot sell consumption goods to stabilize aggregate demand and supply. So you can deal with interest rates mostly, and mostly you can have an impact on the lending. So aggregate demand is easier to be affected than aggregated supply sometimes, but also business cycles will affect aggregated supply as well. So you will have really limited impact. But when people are assessing different monetary approaches, usually they are looking for this loss minimization, which means that output volatility, inflation volatility, foreign exchange volatility, and exchange interest rate volatility should be limited. Or at least the first two should be limited, and maybe that will be a trade-off that, okay, we are reducing the volatility of the output by smoothing out business cycles and inflation, but in this case, foreign exchange rate will fluctuate more because this will absorb the external shocks. Or interest rates will be more volatile. So if we have to measure this one, then obviously we can look for manufacturing output because this is mostly data, so it's higher frequency. We can have GDP also, just GDP is only quarterly frequency, so sometimes we are just skipping shocks. In case of inflation, we can have many different price levels because inflation is the change of the price level, but we are always focusing on consumer prices because producer price index would be absolutely dependent on commodity markets, on external shocks, so it's not reliable. Also, many central banks are just focusing only on core inflation, so they are removing food prices, they are removing energy prices to remove all these fast fluctuating elements from the inflation. And in many cases, they are trying to be forward-looking, so they are collecting market expectations from different agencies, and then they have some targeting towards expected inflation. Later, I will show you how can we use this. Also, foreign exchange volatility, so it can focus on the foreign exchange rate, it can focus on the nominal effective exchange rate or real effective exchange rate, where we are combining all the different exchange rates against our different trade partners, and then we are creating a weighted average against them. So in this case, we have just one number from multiple denominations. And of course, interest rate volatility can be, we can focus on, usually we are focusing on long-term interest rates because short terms are much more volatile, or we can have reference rates. And if we have to determine the nature of shocks, we have a whole list of shocks. So we can be affected by suddenly withdrawn funds. So suddenly external funding is withdrawn, or at least we cannot renew expiring external debt. Collapsing risk appetite can be one reason of such shocks, or increased counterparty risk, or just being afraid of that counterparty risk will increase. So again, expectations about this one. And the problem will be that there can be a drying up liquidity on the market. But before all that, let's meet our friendly economic or business cycles. So this is Euro area data between 2005 and the end of last year. So this is mostly data. This is downloaded from Eurostat. And again, I mentioned that in Europe, we are using manufacturing index because this is the most available data. In the US, they are always using unemployment data, but since there are many different unemployment statistics in many different member states, so manufacturing is much more reliable to deal with this issue. And as I mentioned already, that we need business cycles because we have to understand that where we are in them. So are we in the state of recession, are we in the state of economic growth, or we are just stagnating somewhere? So that's why if you are looking on the blue line, so this is the empirical data, which was increasing until the subprime crisis, then obviously during the crisis it was dropping, then it was increasing a bit, and then stagnating back and forth during the sovereign crisis, and after that it was happily increasing until the COVID, and since the COVID it was still increasing a bit, just after that it collapsed after the Ukraine war. So if we are removing all the cyclical components from this one, so we are just keeping the trend with HP filter, this is how central banks are doing it, then we can have this orange line and we can see the smooth business cycles coming back and forth. So we can see that, okay, if this orange line is decreasing, then we are in a recession. And we can see that it already started. Okay, HP filter sometimes has issues at the beginning. So usually people are cutting off the first 3 and the last 3 points because it can have the tendency to jump up or down. But here we don't have this bias, luckily. So we can see that it's already. Yes. That's the. The global financial crisis. So before global financial crisis, we can see that it's increasing, but already there were global liquidity issues in the December of 2007. So later, when we will talk about international reserves and also swap lines between central banks, we will see that central banks had to create this temporary swap agreements between each other to get US dollars from the US Fed in December of 2007. That was a temporary agreement for just 6 months, and obviously until today we have this. They are just at the beginning they were renewing it, and now it's a standing facility because global US dollar liquidity scarcity is still a problem, and sometimes you are not able to get this US dollars on market basis. So we can see that this is how business cycles are fluctuating. Also, we can do it for emerging economies or open and small economies. That's the same thing. That this is Hungarian data. In this case, we can see the same thing, that it was nicely decreasing or increasing. But what matters the most for monetary policy usage, that here we have this cyclical component. So this dotted line. So the cyclical component will give or highlight the central bank that what is happening within the economy. So if it's negative, then it means that we are in a recession. If it's positive, then they have to, we are above the potential growth. So practically we are in an overheated stage or something like this. Yeah, but also we have other tools, not just filtering, but we can check also with these markov-switching models that are we in different regimes in the economy or not. These markov-switching models are really good because it gives us a probability, so a scale of between 0 and certain probability of 100%, that are we staying within this regime in this month or not. And when people were teaching me right before COVID, so I had a really happy week at the Slovenian Central Bank in December of 2019, and people from the French National Bank were coming there, and they were teaching us this many things, but also markov-switching model, because this is how people at central banks and other research agencies can determine that in which stage of the business cycle we are. Because usually we have these three regimes. So one is about endogenous crisis, we have exogenous crisis. So exogenous crisis, which is coming from outside, so we can see this middle regime here. So this is when the crisis arrived from the US, and also when lockdowns happened. But obviously after that it will be endogenized, so all the local factors will, and policies and policy implementations will add or take to this picture, so we will be in the endogenous phase sooner or later, so this is still a crisis, just a different one. And after that we have a growth period when things are a bit more calm. The thing can, or also in this case, it's easier to calibrate that where we are in the growth stage, when which months different crisis situations happened or ended. And also we can do the same thing for small and open economies for Hungary. Just in this case, yeah, if you are implementing the three regime approach, then at the beginning I was looking for this strange data that, okay, we can look something into it, but it's not that elegant as like for the Eurozone. For inflation, when I was talking about this with people from the Hungarian National Bank, sometimes they are saying that they are using this filtering, but mostly they are not. But still, at least what we can do here, that if we are just defining the inflation targets, so in Hungary it's 3%, in the Eurozone it's 2%, then what are the trend lines for inflation? So obviously, if we are far above the red line, which is the target, in the Eurozone, then it means that we have an inflation shock or a crisis which is related to inflation. So in both cases, we can see just there is this peak and also there is this peak. Just in the case of the Eurozone, this peak happened at 6%, or altogether without any detrending, it happened at 10%. And in Hungary, as an open and small economy, it happened at 25%. So we can say that it's a bit bigger. But also we can see the impacts or the deflationary dangers of the 2008 crisis, when it's a bit under, or during the 2010s when ECB did everything with its balance sheet to avoid any deflationary crisis. So we can see also these signs, but in this case this is not that great. And since I started talk about volatility, but should be minimized. So during the 70s and 80s, when all the modern monetary economics was developed, so people were practically experimenting with different macro models. They were developing their own macro models to assess that which can be useful for monetary purposes. Most of them were junks, but what remained, we are using them today. And the key assessment was, or assessment criteria was, that it should provide low volatility for the output, low volatility for inflation. And the problem is that even if Hungary and the Eurozone has the same monetary objectives, same instruments, everything the same, just obviously the size of the economies are absolutely different on scales. This is where we can see the side effects. So you cannot maintain open and small economy with or under low volatility in the output or in inflation. So the dotted lines are Hungarian data, the solid lines are Eurozone data. It doesn't matter that which country we will put here, okay, except Czechia or Switzerland. All the other cases will be the same, that volatility shocks will be much higher in these economies if they are small, open, and especially emerging ones. Yep. And now let's go back to theory from practice. So, what can we do if we are a central bank? First of all, we can choose obviously foreign exchange targeting, but I think after 2 hours of talking about monetary history and finance history, I was able to highlight that foreign exchange targeting is maybe not the greatest idea. Even if emerging economies tried to do this during the 90s when they were fixing their currencies against US dollars or other currencies, they were efficient because they were able to cut down inflation within several years, but also it was not that efficient because in several years later they had a bank crisis, they had some asset market bubble, or they just defaulted. So this is not good. And second option is pragmatic monetarism. In this case, you are trying to manage the monetary aggregate. So amount of money in circulation, just amount of money in circulation, but all the bank deposits on short run, long run, all the short run bonds available on the market. So this broad money in M2, you are trying to manage it by setting monetary reserves and sometimes also exchange, interest rates. So this is the hardest thing. The US tried this during the late 70s when they tried to abandon the whole stagflation, and this is unmanageable. Nowadays still we can see countries which are doing pragmatic monetarism. We will check it later on, but for example in Vietnam the central bank had pragmatic or monetarist targets, but when I had a PhD student from Vietnam, he told me that the reason is that otherwise the impact of the monetary policy on the inflation would be highly limited. So that's why monetarism can be much more credible that they can do it. But usually these countries, once their financial system is deep enough, then they are going towards inflation targeting, and this is just a temporary measurement to maintain this reserve system, because we don't have any coherent macro-financial model for this one. So we don't know how to set interest rates, monetary reserves, and then we cannot predict that what will happen with inflation or output at the end of the day. Until you have a small country with several million people, you can do it, but at bigger levels, we cannot do that. We can focus on output. People tried to do this during the 50s and 60s by focusing on unemployment, by making these Keynesian monetary policies, and this ended with stagflation, so high inflation and economic stagnation, so maybe that was also not the greatest idea. Nowadays, luckily, we cannot find an example for that one. Or we can have inflation targeting. This is what we have nowadays. So it was developed or finalized in 1992, and then it was practically adopted everywhere. So it's also the target of the ECB. The US Fed is also following some kind of, or follows some kind of inflation targeting with their Taylor rule, but practically the framework of inflation targeting is followed everywhere. In this case, the central bank declares level of inflation for the next 1 or 2 years ahead. So this is not a short-term inflation. This is where they would like to be 1 or 2 years later in the future. In this case, it allows them to see through sudden inflation shocks, sudden price spikes. So they don't have to react on everything. Just if they are not reacting in time, this is what happens. What happened with the European Central Bank then when they were sleeping over during the first part of the inflationary spike of the 2006 2021, 2022, until they realized that, oh, there is an inflation building up, so we have to do something. So they were half a year, or their reaction was half a year behind what they have to do. So this is the term for behind the curve effect. They are not reacting. So let's go through the different objectives. So monetary aggregate targets, as I mentioned already, that they are trying to change M0, M1, and M2 monetary aggregates. The objective is to deal with inflation, but they are thinking that, okay, there is a relationship between the monetary aggregates and inflation. They don't know what, but there should be something. So there are some models for this, but the problem will be that the only tool as a central bank what you have will be the mandatory reserves in the liability side of the central bank, because excess liquidity from commercial banks have to be mandatorily put there, and in this case, this excessive liquidity will be not lent out to households, to companies. So in this case, you can slow down the credit growth, and that's why you can slow down aggregate demand growth. So this is how they are trying to stabilize inflation. And also they can use the policy rate as well, so interest rates can be fine-tuned, but the key instruments are central bank reserves. Sometimes also the central bank can emit and sell bonds. It's a kind of special way of government bond because it's not issued by the government, it's issued by the central bank, but central bank is still part of the government practically, or theoretically at least. And in this case, they can also remove excess liquidity this way as well. This is what happened in China when, or during the early 2010s, when there was a lot of capital was flowing in, there was a huge excessive trade surplus, and to avoid domestic inflation, they had to remove a lot of excessive cash. So sometimes mandatory reserves were around 20%. So because otherwise it would create huge domestic shocks. Okay, and we are hoping that if we are changing monetary aggregates, it will have an impact on inflation and output. Just the problem, again, that we don't know how. So when the United States implemented this in a nice October day in 1979, literally on, I think it was a Friday, that they announced that now we don't care about the yield curve, now we don't care about monetary stimulus, now it will be determined by market forces. From one day to another. So I will show you the impact of this one. So this is when they announced it. So the day of announcement, interest rates were around at 8%, and then it was jumping overnight to 12.5%, and after that it was increasing even more. And this is just for government bonds. So practically they were doubling. We can say that it's marginal effect, who cares? But the problem is that at the same time, all riskier assets reacted. And that meant that, for example, Cyprus-rated companies had a yield of 30% or more. And also what happened that since now we are mingling with the uncovered interest parity, so suddenly they had positive real interest rate in the US, and as a result, obviously, US dollar started to appreciate. And during the whole 70s, it was a great common behavior, let's say, that many emerging or socialist economy was taking up loans in US dollars. Because come on, it's free. It has negative real interest rates. Come on, guys, we can do projects from it. We can outgrow this debt. Until they didn't. So in 1982, we have many common features. So first of all, Mexico, Argentina defaulted. I think also Brazil defaulted their public debt. Also in Poland, to avoid further strikes and any other unrest, there was a coup by the military. So military was taking over from the Communist Party to save the Communist Party, to avoid Soviet intervention. Hungary, to avoid public debt, we were entering the IMF from Chinese loan, because at that point, East German Central Bank and even Bulgaria was withdrawing their deposits from Hungarian National Bank, and also Metallica published their first album. So practically we can see that this year was really strange. So even if we are checking AAA rated bonds, we can see same thing. So that was absolutely a shock there. It was able to stabilize the US economy because inflation was over, but also, the domestic effect. So meanwhile, more than 1,000 US small banks defaulted as well. So obviously, if you are increasing the interest rates, liberalizing the yield curve, so that's why interest rates will increase from themselves or by themselves. But they had that they were lending money on the long run at fixed interest rates for 6%, and at the same time, the interest rates for deposits increased to 12%. So in each US dollars what they were to lend out, then they were losing 6% of interest. So obviously, that was the US saving bank crisis. Since they were rural banks, since they were small banks, that was not the same Lehman Brothers kind of shock, because their portfolios were purchased by other banks, they were merged together, so it was manageable. Just still, this is shocking that what happened even within the US during this procedure. And the problem, or the other problem, is that it's really hard to collect data about monetary aggregates. So you have to wait a month until you can see that you did something and what will be the effect on the inflation, on monetary aggregates. So this is not like interest rate setting that you are changing your interest rate and after that immediately you can see the change within the yield curve. They are nothing like this. So they try to maintain it, but in 1982 the US abandoned this idea because it was not working. So still after that they were looking for something as some kind of an alternate monetary policy. So practically they were within a coherent monetary policy for a decade. So they abandoned the last one in the early 80s and they implemented or started to implement the new one during the early 90s, which is really strange. They were experimenting with this and that. For example, in Australia, they had, or at least they declared that the central bank will focus on currency stability, price stability, and balanced economic growth. So it's like a Miss Universe championship that I would like to have everything and world peace and free beer. So yeah, that was disastrous. So we can say that inflation targeting is a much more refined framework because at least it's with us for during the last 3 decades now. Okay, I told about it a lot. So in this case, we have this hierarchy that we are focusing on asset prices, capital flows, consumption, investments, exchange rates, yield curve slope, everything. And then we have to assess that does this match with our requirements or not? If not, then we have to do something. So we have to have a policy decision we have to adjust the policy instrument, so we have to increase the interest rate or decrease the interest rate. But obviously, in practice, with these policy instruments, we can do open market operations, discount rate settings, open market operations. So we can provide loans, really short-term loans, longer-term loans at the set interest rates. We can set also reserve requirement, but it's absolutely marginal. Moral suasion, who cares? So first two are relevant. Then we can have the operational targets. In this case, we can see that, okay, what is happening within the banking system, so how bank reserves aggregates are generated. Just the problem is that mandatory reserves in the banking system, you have to meet it at the end of the month. So until the end of the month, the central bank is not able to see that what is happening within the banking system. What is much better indicator? Money market interest rate, because we can see it in real time, so this is high frequency data. Then, after that, we can see the intermediate targets, so what is happening with short-term interest rates, what is happening at long-term interest rates, and after that, we can have our objective, so we can have our inflation data. And also stable financial markets, but later we will talk about financial stability, so this is a different bag of potatoes. And after that, when we are going through this, then again, there is a feedback that, okay, we have to check again on relevant data and variable. Practically, we have a model in the back. So, what they did during the 80s and 90s, that they were developing this dynamic stochastic general equilibrium models, so DSGE models, where you can define all the main economic actors. So you have a set of functions for households, for companies which are exporting, for companies which are just focusing on domestic economy, and also all the funding conditions and aggregate demand and supply roles. And after that, you can build up models to highlight what can be expected for inflation, what can be expected for all the interest rates and exchange rates. And then practically you can pre-test your monetary policy decisions before doing anything in the real life. And sometimes, obviously, they are messing it up. So the biggest or the most famous mistake was in August of 2008, when the European Central Bank was still increasing their key policy rate because they were expecting 4% of inflation. And it's twice what they should target. So they were following a restrictive monetary policy. At the same time, the US Fed was already decreasing their interest rates for half a year already because they were in recession mode. And when the Lehman Brothers collapsed in September, then suddenly the same ECB models show that if we are continuing this, then we will have a negative 3% of inflation, so they will have a deflation. So suddenly they started to cut also the key policy rates. So sometimes things are changing fast, or sometimes model can be miscalibrated, and then they have to catch up. Yeah, so targeting output can lead to stagflation, so that's why nobody does this since the 70s. This is not a great idea. Natural income as a target, so not real income, but national GDP growth, nobody did this, so just the book mentioned that, okay, we can have this. Yep, monetary trilemma I mentioned already.